due to your...
All right. Yeah, we're both live. Okay, great.
Live.
All right.
Okay.
Hey guys, we got a little late start today. We got a lot of stuff that's been going on. First thing, start off. Congratulations, John, on your clear to close. Good job, awesome, man.
Congratulations to me, and congratulations to Tommy and Deborah Braden. You guys are clear to close. We've been talking about it. You know, they started out with another lending institution. Lending institution, as we talk about a lot, you know, they had some overlays that we do not have. They were unable to close the loan. We picked it up. It's been less than 30 days, and we are now clear to close. So I think we're going to go ahead and schedule that one for Monday. So congratulations to Tommy and Deborah and family.
John just keeps knocking them out. He's doing a great job, as always.
Thanks, Dad.
Great customer service. So awesome. Well, today we're going to be talking about credit and how it affects you in life, not just with mortgages, but everything else. I'm going to start out, let John talk a little bit about credit and tell me about how it is to get approved for a mortgage with credit and how it can affect.
Well, credit, we all know what credit is and essentially what it's for, but credit, when it comes to mortgage loans, obviously is very, very important. What is credit? What makes up your credit? A lot of people will ask. It's like, most of us are going to know these things, but there are a lot of people that don't. For example, your cell phone is not going to be included in your credit report history, unless that is, you don't pay your bill, you get a collection, and somebody reports it as a collection. But the payment history on your cell phone bill is not reported. Things like your utility bills, your cable, your internet, things like that. Things that are going to be reported to your credit. Things like car loans, credit cards, home equity lines of credit, mortgage loans, things of that nature. And, credit is built up of primarily two things. You've got installment debt and revolving debt. Installment debt, that is like a car loan where you have a balance and a payment and you make a payment each month towards that balance. Revolving is like a credit card where you can have a revolving credit limit and balance, and it can change. Now with installment debt, I'm not sure about the percentage that makes up of your credit score, but in general, you're going to get more points from revolving debt. They grade you on actually 2 levels for revolving debt. Well, I'll tell you about another one. This just happened recently. But with credit cards, you're not only graded on your payment history, whether or not you're making your payments on time or not later than 30 days, but you're also graded on what I would call responsibility, whereas they're basically looking at your balance in proportion to your credit limit. So for example, if you have a credit card with a $500 credit limit, you want your balance to be, at all times, at least 50% or less of the credit limit. So if you got a $500 credit limit, you want to keep that balance $250 or less all the time. And there's a lot of people that will say things like, well, I'm going to pay my credit card off at the end of the month. I'll run it up and I'll pay it off at the end of the month. Well, due to credit card billing cycles, this is just a very generalized example, but maybe you're paying your credit card off at the end of each month, but maybe the reporting cycle goes from the 15th to the 15th. So each month, whenever that credit card reports in, it's actually reporting with the maxed out balance, and the fact that you pay it off every month, isn't even recorded in there. So you always look like you're over the limit. When you're over pretty much 50% of your credit limit on a credit card, even though you're making your payments on time, this reports as being maxed out. It can actually, damage your credit score. So you want to keep those balances on credit cards, below 50%. The closer to zero, the better. But you want to keep something on the card. There's so much I could talk about, but it's like, a lot of people, they think, well, I'm gonna pay all my debt off. I'll pay my debt off and that'll make my credit go up. Well, not true. You pay all your balances off. You've got zero balances. You pay your car loans off. Well, credit ceases to report. There's nothing to score. So you want to keep a healthy, amount of trade lines on there. A couple revolving accounts, installment accounts are good. Credit card balances below 50% of the limit, closer to zero, the better. But Adam.
Yeah. Well, just to touch a little bit base on why you want to keep a balance on your credit card. even if it's only like $10, is due to that some credit card companies, due to inactivity, will sometimes close the account. So you don't want to get rid of that account, especially if you've had it for a few years. As well as what John was saying, you know, if you're paying your bill when the bill comes out, you're paying it on time, it's still going to reflect that balance. So what I always do on my own personal finances, which I'd recommend for you to do, is just pay them like a week early. You pay them a week early, it's going to show up that lower balance. So it's something that you just need to manage it, and I always just pay myself, you know, pay all my bills a week early so it shows that balance up.
Well, what I was getting ready to say is, like, you want to tell them about the, you know, previously, whenever you made a payment on a credit card or an installment debt or anything like that, previously, the only thing that we would be able to see on a credit report is if that payment was not made more than 30 days late. For example, if your bill's due on the 1st and you pay that bill, whether you pay it on the 1st of the month and you pay the minimum payment that you can pay, or you pay it on the 29th of the month and you make the minimum payment, you know, it just reports as an on-time payment and it doesn't show the amount. Well, what's updated here recently is that, you know, credit is actually giving an extra boost when you pay on your accounts and you pay more than the minimum payment. It is actually showing that and giving an additional boost on credit. So, for example, if you've got credit cards with $25 minimum payments and each month, you know, you're making them, you know, not more than 30 days late, so you're making them on time, and you're paying more than the minimum amount or the minimum payment, it's actually going to give you an additional boost above and beyond. And it, you know, it didn't used to report that way. We couldn't see, you know, if you were making more than the minimum payment. So for those people out there that like to make, you know, try to keep your bills down, make more than the minimum payment, that's actually helping you now, whereas it didn't used to.
Yeah, and like John was saying, you know, your credit score is made up of several different things. You know, it's, you know, your installment, your revolving, the average age of your open accounts. So if you've got, let's say you've got 3 open accounts and you've got one at 12, one at 10, and one at 24, and then all of a sudden you close that 24-month one. Well, now you've got 2 open, and now your average opening of your accounts is only 11 months, which with that 24-month account being closed, it's going to lower your credit scores a little bit. Not a whole lot, but it's going to lower it because your average opening accounts history is going to affect your credit score. Same thing if you go buy a new car or anything else. So if you have your credit pulled several times for credit cards, that's a big question that we get a lot of times, saying, hey, if you're going to pull my credit, is my credit score going to drop? Well, not for when you're shopping a mortgage, which John's going to talk a little bit about that. But if you're pulling for like shopping for revolving debt, a bunch of credit cards, it looks from the credit bureau standpoint that you're adding a bunch of debt to your credit report or you're about to. And that credit score is kind of like a factor of what are the chances of you actually filing bankruptcy. That's where the credit score comes from. Is like, what's the chance of this customer filing for bankruptcy? So if you ever notice, if you ever filed bankruptcy before, when you file and you discharge a bankruptcy, your credit scores actually go up. Mm-hmm. Why do they go up? Because they discharge all that bad debt, even though that bad debt is still showing in your credit report. But the chances of you filing bankruptcy now, it's a whole lot less because you can't, because you've already done it. So John, what can lower your credit score besides, you know, like bankruptcies and stuff like that, credit pulls?
Going back to the credit pulls, I mean, because, you know, that is something that I'm sure that there's people watching and people ask us a lot. I mean, so a lot of the times, the first time that you talk to somebody on the phone and they're wanting to buy a house or get pre-qualified, you know, they may have came from another lender, and I mean, there's a real big, I don't know. You hear this a lot in the industry where you go you do a loan application and the lender says, don't let anybody else pull your credit. Now, I mean, this is in my opinion, I mean, this is a big scare tactic when it comes to shopping for a mortgage loan. Because when you go out and you're shopping for a mortgage loan, if you get your credit pulled 1, 2, 3 times or whatever at a few different mortgage companies to shop for interest rates, loan terms, or whatever, you know, this is not going to necessarily drop your credit score. I mean, if you're going out and you're applying for credit cards, mortgage loans, car loans, all at the same time. I mean, things like this can not only look fishy on your credit report because we see these inquiries, but they can also drop the score. But a lot of times that's kind of like try to get you on the hook. That a lot of people will say, don't get your credit pulled again. I mean, in general, once you start, or not in general, definitely, once you start a mortgage loan, now, there shouldn't be anything else that you need to get your credit pulled for. I mean, you shouldn't be trying to buy, new cars or credit cards or anything like that. But, that can happen during the process of a mortgage loan application. But you want to avoid getting it pulled after you've gone into contract, after you've been qualified. But, when you're shopping for a mortgage loan, going to a couple different places, get your credit pulled is not going to kill you. So as far as,
credit scores, I mean, the best part, in having the better credit score you have, the better rate you're going to get. Not just for your mortgage. It's going to be a better rate for your insurance. Your insurance
easier
will be cheaper.
Life too.
Your any auto loans that you have are going to be, your interest rate's going to be cheaper. Even for credit cards, any type of loan that you apply for, everything is going to be cheaper for you, and it's going to save you money per month. And it even affects sometimes your utilities. If you have to put a like
deposits
or not. Everyone looks at credit nowadays, and so the better credit score you have, the easier things are going to be in life, and the cheaper things are going to be in life, that you can pay down your debt that much quicker. What can lower credit scores? Like John was talking about, we've talked about bankruptcies, collections. You want to make sure you don't have, collections. If you do, you want to get those satisfied or recalled, which we'll talk a little bit about that today. We talked about, having your credit pulled too much. What can we do to bring their credit scores up, John? I know that we do that a lot. So what do we do to help bring their credit scores up?
It depends. I mean, there's a lot of times when people will come to us and they are very, they're not very far outside of the minimum credit score to get their foot in the door to qualify for a loan program. So the credit score gets your foot in the door to qualify for a loan program. But just because you have the minimum credit score, that doesn't always mean that your credit history is going to be acceptable for an underwriter to approve the loan. So, I mean, there's two layers to that. I mean, we're looking at the credit score, of course, and then we're looking at credit history. But, not to get this too complicated, I mean, let's just say, a lot of times when we get somebody in and maybe, they need a 580 credit score to qualify for an FHA loan. And, maybe their credit score is a 555 or 560. And, the first thing that we're going to look at is revolving accounts, the credit cards. Do these credit card balances show over 50% of the credit limit? If they show over 50% of the credit limit, the very first thing that we're going to do is we're going to get you to pay those credit card balances down under 50% of the balance, as close to zero as possible. Another thing could possibly be disputing accounts. Now, if you have an open collection, with a balance on it, well, whenever you dispute something, essentially what's happening there is, you're saying that, there's something wrong with this, I don't agree with it. And so for the time being, what happens in your score is that the credit bureau takes that account, the disputed account, and they move it off to the side. So it no longer is a factor in the overall credit score. So then now with disputing accounts, collection accounts that have balances on them, that's kind of tricky because with underwriting most mortgage loans, whenever you have a collection account with a balance on it and it's in dispute, the underwriter is going to say, hey, I want you to either settle this account or I want you to remove the dispute. So in that kind of a case, putting a dispute on an account might just make it to where you have to take the dispute off of the account, and it's additional problems. But let's just say, for example, that you have a collection account with a zero balance that's still reporting. Even though that you had this account paid off or it's a zero balance, maybe it's been charged off, whatever the reason, even though that it shows a zero balance, these things can still affect your credit score. So in one of these cases, I mean, maybe you have credit cards that are over 50% of the limit. We're going to have you pay those down. Maybe you have a couple of old collections that are reporting with zero balance. We can dispute those accounts so that they're moved off to the side. That's going to give your credit score a little bit of a a little bit of a bump. But as far as, with the,
lost your train of thought?
Yeah.
No.
But, with the,
with the collections and stuff, it all depends when that account went into collections. So let's say, for instance, you have an account that just recently went into collections and it's showing up on your credit report. Say it's a few months old. I know I've put posts out there in the past. I'm going to put this in the video as well. Do not call that collection company. Period.
Yeah, might just get a call on you.
Yeah. Call the original creditor. If it's like Cox, St. John Hospital, whatever, whoever the collection company's with, give them a call and ask to pay the bill. Plain and simple. By doing so, if you pay that original creditor and they accept that payment, that collection has to be removed from your credit because that collection company never collected on the debt. And so they should not be reporting. So if it was Cox, St. John, St. Francis, whatever, we just see a lot of medical collections. That's what I'm naming hospitals, by the way. My wife works at a hospital. So they have to, after you pay that off, you tell them to recall the collection. And they have to contact, Works and Lands, Tulsa Adjustment Bureau, whoever it was sold to, and they have to put in a request to recall that collection. And then that collection company will have to remove that collection reporting off your credit, which is going to raise your scores drastically. So if you've got like a new collection or something like that showing up, call the original creditor. A lot of times on these medical collections, what we do is, what me and John does all the time is we look at the medical collections first. Because if the hospital will not accept your payment and they want you to go through the collection company, a lot of times if you pay off that collection, the creditor, the collection company will still remove it by us disputing it. So in either way, even if they don't, it's going to show a zero balance and it's going to raise your credit scores no matter what. But it's going to be a difference between 5 points and maybe 25 points. It's usually about 20 some odd points if it's completely deleted, depending how old it is. If it's just updated as paid, it's usually about 5 points. And so if you've got a lot of those, it's always good to, contact me, John, or anyone here to go through your credit, let you know which ones that we need to dispute, which ones you need to take care of, and get them knocked off your credit report. So,
well, I mean, with credit is a difficult thing to talk about because, to talk to people in a broad sense is almost impossible. Everybody's credit has so many variables. I mean, the age of your accounts, the number of collections, what type of collections these are, how many revolving accounts, credit cards that you have, installment loans. Maybe you're somebody that we need to get you signed up on a credit card to get some credit history reporting. I mean, the gist of what we want to convey here with this video, most of the mortgage lenders that you go to these days, if they pull your credit and it's not a straight shot, okay? If it's not a straight shot, they're going to send you down the road and that's it. Right. But, it's like, we're going to look at your credit. We're going to look at factors that are going to increase your score in the short term. We work with a lot of really good credit repair agencies. I mean, there are a lot of times that I will refer people out to credit repair agency whenever they need help that's more in the long term. I mean, there's a number of things that we could do in the short term. But just because you've been told no in a different lending institution, be it for the credit score or the credit history, that doesn't always mean that there's not a way to get it done. I mean, we have very minimal, no overlays on top of basic lending guidelines for all of our different loan programs. We're willing and able to help you with your credit, whether it is a short-term problem where you just need to boost your score 20 points to get the next tier and the better interest rate, or if you need an overhaul, we can get you set up with somebody or help you ourselves. So, like I always say...
I have a question.
What's that?
What do you use for credit repair agency?
I'll tell you, my friend Micah Scobie, she is, I don't know, is she watching today? She does a very good job. Doc Compton, Doc Compton,
What about the people who don't have the money for credit repair agencies?
Well, people that don't have the money for credit repair agencies, we always help out.
Exactly.
That's what I'm saying.
Yeah,
So-
we're a team. So
We're going to get your loan done. You come to us. Your housing needs, your desire to buy a house, get a mortgage loan, get a good mortgage loan, and go through a painless process, or as painless as it can possibly be. You know, we're concerned about this, and I mean, we're going to work with you. We're going to do what we can, whether it's something that we can do ourselves that's going to cost you no money. Because, you know, that's, again, by the way, we do not do credit repair as a business. That is not something that, you know, you're going to talk to us and we're going to say, oh, yeah, great. We get your score up 60 points, but, you know, we need $500 and $60 a month for the, you know, the next 12 months. I mean, we're talking about doing this. This is just part of our service that we try to offer just to try to help our clients out, to get better loans, to get approved in general.
yeah, and what we do is we do it for free. So, I mean, we don't charge anything for it, and it doesn't take 6 months or a year or anything like that. You'll be surprised if you follow what we say and what needs to be done on your credit. We've had it done in quick as a week to 30 days. It just depends on you as the consumer following our instructions and paying off what needs to be paid off, and then we will handle the rest. You know, getting that credit cleaned up, getting those disputes, reaching out to Equifax, Experian, TransUnion, and going through that with you. Of course, we don't do that during working hours. A lot of times I'm doing it on my laptop at night at home, which I do a lot of. So if
I do whatever it needs to happen.
Exactly. So, and the reason why we don't do it during working hours is because we have to work on files that are currently in process. We don't want to take away from the current clients, and that's why, you know, we do it at night, so that way we're communicating with all our real estate agents and clients who are, you know, are in a contract right now. But we will always service, you know, the people who are trying to get their credit cleaned up and get to be able to get into a mortgage, save money on their insurance, save money on their auto. Because when we raise those credit scores up, what I always recommend, and what John always recommends, is that after you've closed on your
Can you tell
home.
me what I say?
Oh, I'm sorry, my bad.
Just
Okay,
kidding.
I only say this then, okay?
No, I say it. He said that I say it. You know, say whatever Adam says.
After you close, a lot of times I will see on there like a Santander auto account or some auto account that they're paying 21% interest rate. And, you know, we've raised their credit scores, you know, 60 points or something. After you close, of course, on your mortgage, we always recommend for you to refinance your auto and save yourself, you know, $100 a month, or shorten that term, which we'll get into more of that stuff in another podcast with, you know, financial management. So that's a couple podcasts down. But like I said, does anyone have any questions, or do you have anything that you'd like to add, John?
You know, let's see here. Let's see. I don't know. Well, Dan's got a good idea. He sets his credit cards up on auto pay.
10% of the
10%
of the limit.
Yeah.
So
Well, you know,
10%.
auto pay is a good thing. I mean, it all just comes down to, you know, like I said, with the credit cards in our society. I mean, you can go out right now, and I mean, it's real easy. There's a lot of people that are living, you know, paycheck to paycheck, and it's really easy to go out to Capital One, you know, somewhere like this, and you can go apply, and you're going to get a you know, a credit card with a $600 credit limit, a 23% interest rate. You know, it's going to cost you $65 to activate this credit card. So the second that you get this thing in the mail and you go activate that card, you've already got a $65 balance on it. And remember what I said, when you're over 50% of the credit limit, it starts reporting as derogatory credit. So with these credit cards and, you know, large activation fees, high interest rates, people living month to month, it's easy to get one of these cards and, you know, activate it. You've got a balance, you buy some groceries, you buy some gas, and boom, you're over 50% of the limit. You know, maybe times are tough, you know, you need to pay some bills on this card. Next thing, you're paying your utilities, and, you know, then you can go get qualified for more little credit cards for $300 and $600 and such. And once again, it's easy to run these things up. And I mean, we see this time and time again. I mean, you can have somebody with, you know, 3 or 5, credit cards with $300 and $600 balances that they ran up just to get by. And so it's real important to pay attention to, your revolving accounts, your credit cards. Do the best that you can. When you get these cards, I mean, I know that for some people times are tough. You got to do what you got to do to get by. But it's like, as a whole, do the best that you can to get these credit cards and look at them as a way to build your credit, because credit cards, revolving accounts can be a really make or break thing to, boost your score or severely drop your score and get you into horrible debt. So, I try to tell people, look at these things not as a vehicle to spend money or to obtain things. Look at these credit cards as a way to build your credit. Try to keep your balances down. Whenever you make your payments on time, keep your balances down. That is going to lead to credit cards with better interest rates and better terms. And pretty soon you're not going to have these kinds of issues. So, other than that, with the credit, the credit cleanup, credit repair, very, very broad topic. The main thing that I want to convey is don't pre-qualify yourself just because one lender tells you that you are never going to get a loan. You don't necessarily have to believe that. Give us a call. Let us have a look. If it's difficult, we're not going to send you down to the road. We're going to look for a way to make it work.
Yeah, and some people are like, hey, I don't want to pay an activation fee. I don't want to pay all this money to have a credit card. Well, sometimes it's a necessary evil. What would you pay to have higher credit scores? Pretty much. That's what it equates down to. Because sometimes we're going to recommend for you to get a credit card to boost your credit scores. And so you're just pretty much paying money there up front to raise your credit scores, essentially. So that way, everything down the road is going to save you a lot more money in the long run and stop looking at the short.
Well, we all have people that, they, like I said, people think a lot of times it's like I'm going to pay off my debt and my score's going to go up. Or, I pay cash for everything. And it's like, that's great. If you've got, $1 million in the bank and you can pay cash for everything, that's great.
You don't need
But
us.
it's like, unless you are going to be a survivalist and live off the grid, you really need to get some credit history going. Paying cash for everything does not build your credit up.
Right.
You could get yourself in a predicament where you don't even have a credit score. Right. And that's an issue, to build someone's credit score from zero. So it's like, you want to keep at least 1 or 2 revolving accounts. You want to keep an installment account, keep those balances under 50% of the credit limit. On the installment accounts of car loans, make sure to pay them on time, not later than 30 days. Nowadays, if you can pay extra above and beyond your minimum payment, always do that. It's going to give you an extra boost. So with time and consistency on your payment history, your credit cards and your installment loans, your credit score will raise. And this is going to make your life and our life a whole lot easier.
And with that said, don't just get any installment. Don't get just any credit card. When you are shopping for these, you need to find out if they report to all 3 bureaus. Because every once in a while you'll get like a credit card or something, and they don't even report to the credit bureau unless you're late on some of these that are online. So it's always good to check with us. We know all the ones that report to all 3 major credit bureaus, and you want one that's going to report to all 3 credit bureaus. So then that way it's going to affect the score on every single one.
My friend Micah Scobie, who Scobie One Kenobi, she is a credit repair expert, and she brought something up that has eluded us during our little talk here, is secured credit cards. There are times whenever an individual cannot qualify for an unsecured card. A secured credit card, all that is just where you have a credit card. It can be through any one of the major, credit card companies. There's all kinds of different places out there. But basically, you put a deposit on this credit card, and you're given a credit limit equal to your deposit. Now, do not get this confused with, for example, a Green Dot card. A Green Dot card is like a prepaid account, like a gift card. Those do not report to the credit bureaus. They do not have anything to do with your credit. They basically act kind of like a checking or savings account with a debit card where you can spend money off your account. What we're talking about is a secured credit card. Chase has an excellent secured credit card program. Bank of Oklahoma has a good secured credit card program. First Premier, Capital One, they all have them. And, if you do not qualify for a conventional unsecured card, you can always get a secured card. And once you get one of these cards, you put a deposit on it, you prove your credit worthiness, that you've made a couple payments on time, you're going to get more credit card offers for unsecured cards. But, there's a lot of times the secured cards will have, better terms and, better interest rates. I mean, because essentially you're playing with your own money there.
Yeah, you're paying back yourself.
But secured credit cards, that's the thing, is because a lot of people, I've heard, them say, well, hey, I can't qualify for a credit card, so what do you want me to do? Secured credit card is what you want to do.
But if anyone has any more questions, they can always reach out to us if they weren't part of this podcast and you're watching this video, and let us know, and let us take a look at your credit and be able to advise you and help you out and get you where you need to be, not just for mortgages, but for everything else, that deals with financing in life, or insurance, or utilities, or whatever.
Like I said, don't be a survivalist. Don't live off the grid. Let us help you with your credit if you need some help. Get good interest rates. Live an easy life. That's my recommendation.
All right.
Okay.
Well, I don't think there's any more questions out there. I don't see anything. I see a lot of people watching, so we do appreciate you guys watching and following us.
Yeah.
Hope you all have a great week. And if you have any questions, just reach out.
Yeah, reach out. It's something I will tell you.
Oh, the closer.
The closer, or drone. Adam and I have been practicing diligently with this thing, and we've got pretty good. Yes. It's almost kind of creepy, the things that we can do with this. We want to try to do a little bit of visiting. Some of our real estate agents, maybe some builders and such. Right. Bring the drone out, try to freak you out a little bit. I thought about putting a Halloween mask right here. That might impede the vision of the camera, though. But, we saw Kara had shown me the other thing where you dangle like a witch from it or something like that. We thought about maybe dangling a tiny baby, but I don't know if that's legal, so we probably won't do that. But
put a follow mask on it.
Yeah, be on the lookout for us, guys. If you got questions with mortgage loans, credit repair, if you just want to call and talk to me and ask me how my day is, you can do that too. I may not answer, but I will get back to you as fast as I can. So, Adam?
Yeah. I think we're good.
Hey, good evening.
All right. We're out.